Hey, Jerry, welcome to the show.
Hey, thanks for having me.
So, why don't you take a few minutes, give everybody a bit about your background? I believe, and again, I always start with this if my research is right, you joined Mount Lucas back in 1997. You're now COO and senior portfolio manager. So, how did you get into managed futures and how did you end up at Mount Lucas?
Sure. So yeah, I've been in the business of managed futures almost 30 years now. So that's you know quite some time. So I eat, live, and breathe managed futures, which is sort of an odd place to find myself. But um, yeah, it's been a great ride. I started with Mount Lucas right out of college, out of Villanova University. Started on the trading desk, doing some programming and automation around that. We were pretty small at the time, built up the trading systems, got my hands sort of all over the company, which is sort of how I got into the role of today running their managed futures strategy as well as being the chief operating officer. Uh, yeah, it's been a good run for sure. Mount Lucas has got a great history. We spun out of a firm called Commodities Corp back in 1986. Commodities Corp, for people that don't know, was sort of the birthplace of managed futures, global macro investing. A lot of big names came out of there, like Paul Tudor Jones and Louis Bacon. Uh, Frank Vanderson and Tim Rutterow were founders of our firm, spun out in 1986. Commodities Corp was in a building in just outside of Princeton, New Jersey, on the corner of Poor Farm Road and Mount Lucas Road. And we were spinning out, become a commodities trading advisor, and Poor Farm Road was not a great name for an asset manager. So in the space, so that's how we ended up being Mount Lucas, and we started running money. The idea was to run and manage futures investing for institutional investor. Eastman Kodak's pension plan had come to us and said, we want to run a managed futures portfolio. It was a risk of money, needed to be registered with the SEC as an RIA. Commodities Corp didn't want to do that. Frank and Tim did. They spun out Mount Lucas, and away we went and got ourselves into the managed futures business, managing institutional asset classes. Been doing that ever since. We also do global macro as a firm. And then, launched the managed futures product, sort of outside the SMA and the hedge fund world into the ETF world back in 2020, and been running that pretty successfully. I think there was some pretty significant market environments during that period.
Yeah, I definitely want to dive deeper into KMLM, which is kind of the main focus of today. But I also want to talk a little bit more about Mount Lucas. But before I do, outside of work, what do you like to do when you're not trading commodities?
Yeah. Well, I've got three kids, all college age and above, so that's been certainly a ride. All three of them played sports in college. So I had a rower, my daughter is a basketball player at Fairfield, and my youngest is a baseball player at Virginia. So that's been quite a ride. And myself, I played tennis in college. Don't play a lot of tennis anymore, but do a lot of platform tennis. So for the few people in the Northeast that know what that is, it's sort of outdoor tennis you can play in the winter up on a platform with chicken wire cages around you. So that's where I spend most of my free time doing that.
Yeah, I played for a year. I'm in the Northeast as well. I'm in Pittsburgh. So I played for about a year, maybe two. And when I saw one of my best friends pop an Achilles, I was like, I
Yeah.
think I'm
Yeah.
done with platform tennis.
Yeah. It's sort of like pickle. It's an orthopedic dream, it's like as many people as can play, keeps them all in business.
Yeah, it is fun, but I'm not taking the risk. I've got too much to do. I have two young kids and I'm chasing them around. It's with a popped Achilles doesn't seem fun. But anyways, back to business. You mentioned a little bit, Mount Lucas. It was founded in 1986. In 1988, they actually created the MLM Index. So that really is a big part of the origin story, where this is kind of the first passive index measuring the returns of futures investing. So that index is largely, from what I have read, has remained unchanged for almost 40 years in an industry obsessed with new models and constant optimization. And so what's the case for a strategy that stood the test of time without being tinkered with after all these years?
Yeah. So I think that goes back to, the origin of the MLM index in 1988. As I said, Eastman Kodak's plan had come to us, and we were running, a range of managed futures models back then. And sort of what happened was we started running money for Kodak in late '87. Clearly a bad environment for stocks. We did well. They were happy. Their chief investment officer had come down for a site visit the following quarter and asked, I think, two important questions that sort of set the DNA of the firm. The first being like, managed futures did well. You said this was going to be defensive and risk mitigating type of strategy. But why did it work? What's the win behind the sales in managed futures? Is there a durable investor risk premium there? The second question he asked, he says, I know you guys did well, but I don't know on a relative basis how well you did. Like, is there a passive benchmark to the space that I can compare you to? And at the time there were manager-based benchmarks, which are the average of whatever the managers were, but there was no sort of price-based benchmark like the S&P 500 is to stocks, or Dow Jones is to stocks. So, for us, in the 80s, a bit of the Wild West in managed futures early on in the asset class. My partner, Tim, always says, I had to look benchmark up in the dictionary. I mean, we were traders. We either made money on a trade or we lost money on a trade. The benchmark was zero. You either made money or you lost money. So, but it got us thinking about, is there an investor risk premium here? Is it durable? Why does it exist? How does it exist? And to answer that question, we thought about why futures markets exist at all, and futures markets how they're different than equity markets. So futures markets are, well, if you think about equity and credit markets, they're all part of the capital structuring of businesses. Businesses and companies want to build and grow. They look to investors for capital, and those investors seek to earn a risk premium associated with capital appreciation, earnings growth, dividend growth, all the things people have been doing for hundreds of years, sort of investing in global growth of the world and economies. And everybody should be doing those things. But futures markets exist because those same businesses and companies, once they're up and running, face real operational risk around prices, around whether they're changes in interest rates, changes in commodity prices, whether input or output, changes in FX rates if they're selling goods internationally. The changes in price, if you're a corn farmer and in price of corn dramatically drops between the time you plant it and the time you harvest it and sell it, face real risks to their margins, to their businesses, and have ongoing operating concerns. So futures markets exist, give them the ability to go into those markets, hedge away that price risk that they face, that they have no control over. It gives their businesses price certainty and an ability to concentrate on running their businesses as efficiently as possible without worrying about exogenous risk. Where we step in on the investor side, the managed future side in the futures business, we're taking the other side of that risk transfer. We're systematically owning price risk through time. That's the function we play in the futures markets. We're a $350 billion asset class. So it's a very sizable asset class. And we participate in the price discovery and the accepting of that risk through time from companies that need price certainty. We're willing to accept that price uncertainty. And then the next question is, what does that mean? You systematically accept price risk through time. How does that work? How does one go about earning that risk premium? And quite simply, probably the simplest, most efficient way of doing that, accepting price risk through time, is through trend following. Managed futures is predominantly 80-90% systematic. Everybody's doing trend following in some sort of way. There's a lot of different ways to do it. But if I was to leave this conversation with anything, we are participating in an economic risk transfer. There is a premium there that exists, and it exists. And if you think about when that premium is most impactful, it's when markets get really volatile. Prices are disrupting, moving from one level to another. Periods like inflation, deflation, those are all strong markets for us. Recessions that create deflation, all the sort of crisis stress type events that equity markets and long only portfolios hate. we tend to thrive in, because that's when prices are getting disrupted and there's a lot of price risk that we are owning during those periods of time. Where trend following doesn't work, it's the flip side of that. Stable markets, zero interest rate world, markets aren't moving around a lot. There's not a lot of trends there, but that also sort of makes sense if you think about risk transfer going on under the hood in the futures markets, because businesses and companies, they have price certainty. Prices are stable. There's not a lot of risk premium in when prices are stable in the futures market. So why managed futures works in portfolios is because we do well when things are going really bad. When things are stable and equity markets are just marching on up, where prices are really stable, we don't do as well. So at the end of the day, we're diversifying, we're uncorrelated to stocks and bonds, and then tend to get pretty negatively correlated every time there's some sort of stress event, like 2008 or after the tech bubble. 2022 was one of our best years in the industry, and even early this year, the ability to be long commodities was really impactful to both our strategy and our impact to end client portfolios.
Yeah, I definitely want to talk about some of those areas because managed futures, in my opinion, are always something that, should be owned, and then advisors end up selling them at the wrong time because they're a return drag, and in reality, they need them there when markets get pretty volatile, or you have, as you mentioned, a situation like 2022 where nothing really worked other than managed futures. So let's talk about KMLM, though. It's the Crane Shares Mount Lucas Managed Futures Index Strategy ETF. You guys launched this back in 2020. What is this fund actually doing? You just did a great example of how managed futures work, but what should somebody expect inside this fund?
Yeah, so the fund is replicating the index we built back in 1988. So it is trend following 22 futures markets. So it's some of the largest, most liquid markets in the world. One thing we always talk about in managed futures is the ability to do well during periods of stress and periods of crisis. The nice thing about these markets, they're exchange traded. They're very, very deep. They're very liquid. In the fixed income space, where you're talking about trading in the U.S. 10-year or the U.K. Long gilt or the Japanese government bond or the Canadian government bond. Deeply liquid markets in the currency space. It's the yen, it's the euro, it's a Canadian dollar, Australian dollar. In the commodity space, it's crude, gold, natural gas, heating oil, grain markets like beans and wheat. Deeply liquid markets. And in periods of crisis, that liquidity holds up. I tell people our strategy, it tends to get more liquid during periods of stress, not less liquid, and not a lot of alternatives, and particularly things with privates or illiquid assets underneath the ETF. Not a lot of alternative strategies can say they're that liquid. And so we have the liquidity in KMLM as the liquidity in the ETF, but it also has the underlying liquidity of markets that tend to, as I said, get more liquid in those periods of stress, because a lot of them are used as safe haven type of assets, and it's where assets are flowing. Anytime you see periods of stress, you see it expressed in bond markets, and you see it expressed in currency markets, and you see it expressed in commodity markets. And that liquidity is important, particularly for a diversifying strategy. Because what you need out of your diversifying strategy is liquidity and the ability to harvest and monetize that diversification when you need it most. And in a period like 2022, where we're up a lot, or 2008 where we're up a lot, and equity markets are, in 2022 bond markets were also struggling. It's great that we're up a lot, but if you can't use that diversification we're providing you in the moment, and sell some of us, rebalance back into your stock and bond portfolios, you're sort of missing the point. If I think this is something I've started to say a lot recently, is that advisors and investors need to start thinking about liquidity as and rebalancing as alpha. A lot of people look for managers to provide alpha in their particular strategy, but that liquidity in a diversifying strategy is alpha to the advisor. It's the ability to take the thing you're using for defense and turn it into offense at the moment you need it the most. So, it's a hard thing, when we get, with our institutional clients, when we've been most successful, we've seen sort of our largest redemptions, because it's them saying, "Hey, thank you very much. I need to make, payments to my beneficiaries, or this is great. I see stocks on sale. I can get them for, stocks on discount. I'm going to take your gains. I'm going to rebalance that back into my equity portfolio." And then you get the real sort of, the miracle of compounding effect of a smoother ride compounding on a higher number. That's the real alpha advisors can add, is liquidity plus diversification allows you to monetize it at the right times.
So when I was looking through the portfolio, as you just mentioned, it's like 22 different futures contracts, commodities, currencies, global bond. But one thing that stood out to me is there is no equity exposure. I think a lot of your competitors include stock index futures. Why is equity index futures deliberately left out?
So yeah, so I mean that goes back to the original construction, right? Back in 1988, equity index futures weren't really a large thing. I mean, they were probably S&P index futures, but they didn't have futures on a lot of the country equity index markets. That's proliferated a lot over the years, and I think the consideration to add them has always been there as far as our index committee. Because we look at the constituents every single year and decide what we want to add or not. But the feeling of the firm was that is understanding why managed futures is used in a portfolio. To us, trend following. It's not that trend following equity doesn't work. It tends to work well, particularly in periods of bull equity markets. So it helps managed futures do a little bit better during bull markets. But it does that at the cost of providing less protection when needed most. And having equities tends to muddy the diversification benefit. No, if I were to own managed futures and that was the only investment in my portfolio, I'd probably trend follow equities. But that's not the portfolios that people have. People already own equities. There are better ways to own equities than trend following. And what they're coming to us for is for diversification. And by me adding equities and adding to the end client portfolio's equities, I'm muddying up that diversification benefit. So what we wanted to do was keep our strategy pure so that it could maximize the diversification benefit when it's needed most. And again, it's a decision to say, hey, maybe we're going to give up a little bit. We're going to have a little bit lower average return than maybe somebody that is including equities, but in the moments that you need us the most, in the moments that you hired us for, we think our construction is going to do a better job at diversifying at the most important times.
So I know this is going to go back to original index construction, but this is one of the more unique, I would say, weighting structures I've seen in all the ETFs I've talked with. It's based on relative volatility. So you're weighting these futures based on their relative volatility. I'm assuming that relative volatility over time changes and therefore weightings change. So can you kind of walk us through that process and how often you're kind of looking at relative volatility in order to adjust the weightings of the portfolio?
Yeah. So when we launched the index back in 1988, we were actually, I believe back then it was 25 markets and we equally weighted them. Um, and that was sort of okay because we, of those 25, I think 16 were commodity. And the thing with commodity markets is they're a lot more volatile than bond or currency markets. And what ended up happening, it was from a risk standpoint, it was really a commodity dominated index. And again, at the time, I was okay because most of the managed future space was primarily a commodity investment. But as markets evolved over the 90s and 2000s, currency markets and bond markets became much more uh, important in the space. And in 2005, we went to this sector weighting where as we allocated exposure, we gave 42.5% to bonds, 32.5% to currencies, and 25% to commodities. And the reason we did that was, it's relatively simple. Bonds got the most exposure because they're the least volatile. Currencies in the middle. Commodities got the least exposure because they're the most volatile. The idea being that through time, each sector, so bonds, currencies, commodities, would have an equal contribution to risk through market cycles. Now, we haven't changed. We look at those weightings every year with an index committee, but we haven't changed them since 2005. And it's not because volatility of those markets hasn't changed. We certainly saw bond volatility drop very low in the teens, but in the sort of the answer to that would have been to increase exposure, even more dramatically in the bond space. And our feeling is we value being roughly right on these weights instead of precisely wrong. I would say a lot of what goes on in managed futures, or the way they size positions, they're usually looking to achieve a constant vol target among all the constituents that they trade in. So they're constantly looking at past volatility in order to size each one of their positions so that each individual market is providing the same risk contribution to the fund. We think that approach, again, it's another one of these things. It is fine, but it's counter to what drives returns at trend following. So the technique a lot of firms use is called vol scaling, and basically what it means is if the volatility of a particular market is falling, they take more exposure, and if the volatility of a market is expanding or rising, they reduce exposure. And if you go back to how I talked about the risk transfer in this space, and when trend following works, well, we work best when markets are more volatile, and we think we should be holding on to positions in a more volatile market because that's when it's working. That's when there's profit in the positions, and we got to let that profit run because that's how we provide diversification to equity and bond portfolios. What happens if you're vol scaling is you get into a market crisis and vol is expanding across all markets. And then if you have a managed futures guy that's reducing exposure into that vol expansion, he's monetizing his gains, which is great, but he's reducing his diversification potential to the end client portfolio. So the manager's sort of getting all the benefit of that exposure reduction, but you're not getting the benefit in your end client portfolio, because the way really you want to own that as an advisor, in your asset allocation, it's like you want us to get all the gains that we can so that you can monetize those and pour them back into your stocks, not me monetize them inside my portfolio. And ultimately, that's what happens with vol targeting. It's not wrong. It's not a bad practice. It does work and improves Sharpe ratios of strategies in our space, but it does do it at a cost, and the cost is and it is in the diversification potential.
So we kind of already talked about the power of the portfolio. Like in 2022, stocks and bonds fell together. People were questioning the 60-40. You guys were up, somewhere in the 30% range. And that is kind of like the real pitch for managed futures. And we also already kind of touched on how that uncorrelated return stream can really help balance out returns and help, compounding over a higher base over time to make it more attractive. But in reality, the way that you can provide that is that this portfolio can go long or short across all of these markets. So you're not relying on just prices going up to make money. So can you walk us through how the short side works and why that matters so much?
Yeah. So just to back up from a high level, I mean, all trend following is in the way our index approaches it, it's really, given that we're an index, it's pretty straightforward. If a market's going up, we get long. If a market's going down, we get short. We use a long-term moving average, a 1-year moving average. If price is above it, we're long. Price is below it, we're short. We look at it every single day, rinse, repeat, do it over and over again. But what managed futures does, it gives you optionality to a wider range of market events by being able to go short things and being able to be long things. So in 2022, we came into the year long commodity markets. They had already started, a lot of markets had already started to move higher. And when the Ukraine war started, you created shortages in wheat, which bled into the other grain markets, and you get shortages in natural gas. Plus, oil markets got ripping. All those things. We came into 2022 with the exact right positions on in commodities. And we actually came into the year largely short bond markets. And, for the first 5 months of the year, that commodity trade dominated our results, and commodity markets started to stabilize a bit. And then we saw, and then the world said, hey, wait, these higher commodity prices, these higher energy prices are going to bleed into inflation. Um, what's the Fed going to do? And then all of a sudden we saw bonds sell off pretty aggressively through the end of the third quarter. And, we sort of got that end of the third quarter gift from Liz Truss over in the UK that really drove the gilt market crazy over there. But, that's in the weeds a bit. But the ability to be long or short a range of these asset classes is really powerful. In 2008, being short commodity markets and being long bonds was the right place to be. 2022, it's the opposite. Long commodities, short bonds. In a 60-40 world that can't depend on bonds stabilizing equity drawdowns anymore, if the Fed or the world has any concern about inflation, or inflation is top of mind, bonds just can't deliver the kind of protection they did for the 40 years previous to 2020. Again, we've been in this business a long time, going back into the 80s, and the founders back into the 70s. They remembered that managed futures work during periods of inflation. Then nobody saw it for 4 decades. So it wasn't a surprise to us, given our firm history and DNA, that it would work again. Managed futures kind of got thrown into this crisis risk type of thing that'll work if there's a big recession. Well, hey, we don't just need prices to move one way. We can work in different types of environments, inflation being one of them. And in all reality, in 2022, or even so far this year, which markets seem to be trying to front run a 2022 trade again because of the Iran war and the downstream effects that it'll have on inflation. There is no other asset class out there that can get you as short as bonds as we can. In 2022, tips, gold, all the normal inflation things didn't really work, but being able to be long commodities, short bonds did work in a significant period of inflation. And again, it started working decently this year as well.
So Jerry, we're coming up on time, but I have to ask, one more question. The fund pays a meaningful annual distribution. Where does that come from, and how should investors kind of think about this annual distribution?
Yeah, so it's not a return of capital for sure. It's a return of gains as sort of required by 40 Act rules. So in a year where we make money, we will have to distribute the gains in the fund. The futures, at least the currency in the bond futures, they earn. So the way futures markets work is they get 1256 tax treatment, which basically means they get marked no matter what at the end of the year. And 60% of the gains get treated as long-term and 40% get treated as short-term. The commodity markets, those positions exist in a Cayman structure and get passed through as ordinary gains. So the way I think people should think about it is, if the fund's up a lot during the year, they should expect a dividend. If it's down, they should not expect a dividend.
Perfect. Well, Jerry, I really appreciate you spending some time with me today. Before I let you go, where can people learn more about Mount Lucas and get all the information they need on KMLM?
Sure. So Mal Lucas, you can follow us on our website, www.mallucas.com. You can also find us on LinkedIn and X, as well as the fund website, which is craneshares.com.
Great. Well, again, Jerry, thanks for hanging out with me today.
Yeah, thanks for having me, Brad.